We went over some candlestick types, so now let's look at candlestick patterns. Now remember that candles are themselves only lagging indicators of market conditions. And what this means is that any information that is obtained through the type of candlestick or candlestick pattern has already happened. When you are looking at trading candlestick patterns, you're basing your trade bias and entry off a hypothetical price movement based on past patterns and other indicators. I will stress it again. Traders, you need to add additional confluence or agreeable tools in order to form a valid entry off of a candlestick pattern in your trading plan. Please do not just trade right off of a pattern. Pattern trading truly can be reliable, but never should it be an absolute indicator of directional movement of the market. With that said, let's just take a glance at some of the most popular patterns. But first, we want to know that chart patterns really fall broadly into three different main categories. And those categories are continuation patterns, reversal patterns, and bilateral patterns. Now, continuation patterns possibly signal that a trend will continue and that the market is taking a break or engineering a liquidity grab before continuing an expansive move in the same direction in which it came from. And reversal patterns are the opposite and could indicate that a trend may be about to change direction and that you need to use caution. This is going to apply if you are calling for a continuation and looking for an entry. Then you need to be aware that there's possible reversal pattern forming. If you are in a live trade that is opposite of the reversal pattern setting up, then make sure you're managing your trade or go ahead and secure some profit in case it reverses on you. Or if you're looking for an entry based on the bias of price reversing in the opposite direction in which it came from, then you might want to be paying attention to that setup because it can kind of give you the indication for your entry. Bilateral patterns are patterns that can vary from trader to trader as to which patterns actually fall into this category. And honestly, I consider every single pattern to fall into this category in my trading. I only take into notice what might be setting up, but a bilateral pattern indicates that the market is highly volatile and that price can easily move in either direction. And I am always looking at that the market could at any moment go in either direction. That just because it prints a pattern doesn't mean that it will go that way. But we recognize setups, and along with strong confluences, you can really craft a strategy and couple that with a solid trading plan, and that is going to give you a market edge and send you on your way to becoming a profitable trader. We're definitely not going to dive deep into patterns in this video, but let's just touch on a couple of patterns here and also take a look at them on a live chart. And the first pattern that we're just going to kind of glance at is going to be double tops and double bottoms. And you'll also hear this sometimes referred to as trading the M's and W's. These are a reversal pattern observed through technical analysis. A currency will typically experience a peak before retracing back to a level of support, and then it will once again climb to the peak before reversing back more permanently with either strong buying or selling pressure against the established trend. And for this pattern, there are peaks. Here you have two peaks on the double top, hence double top and double bottom. You have peaks here. And then you have what's called the neckline. And the neckline is this line of support right here. And you just kind of would draw the line across right here at the neckline. And then usually people would enter a trade here right after the breakout of the neckline, either after price closes beyond the neckline or they wait for price to come up, retest the neckline, and then move into their chosen direction. The next one we're going to look at is triple tops and triple bottoms. A triple top pattern is created when a currency price creates 3 peaks at nearly the same price level. It signals that price is no longer rallying in the trending direction and that lower or higher prices, depending on which direction we're going, are on the way. A triple top is a bearish reversal pattern, and a triple bottom is a bullish reversal pattern. And it's just like the double tops in that it has peaks. So here on the triple top, you have 3 peaks at about the same price. You have a neckline, which is a level of support, and entries are usually made after the price either closes below that neckline, or for some traders like to come down, wait for price to retest the neckline, and then they would enter right here and then follow profits out, just depending on whether they take profit at a certain number of pips or do a trailing stop loss, or several other ways to manage the trade. But usually the entry is done after price closes beyond the neckline, leaves, comes back, sometimes to retest on a break and retest, and then move out. Head and shoulders patterns are similar to the triple top, except that there is usually a really large peak with a slightly smaller peaks on each side of it. And traders use this pattern to predict a possible bullish or bearish reversal. And in this pattern, typically, the first and third peaks are smaller than the second peak, but they will all fall back to about the same level of support, which is the neckline. Usually once price breaks out of the neckline, pattern traders will look to place a trade in the new trend direction. And this one is very similar to the double top and the triple top in that it does have peaks. It has 2 shoulders. So the 2 sides are called shoulders. And then the head is that second peak, which is usually taller, a much larger peak before the price reversal. The same here as you have a shoulder on each side, and then you have the head, which is a much larger peak before price reverses. And there is a neckline that you're looking for price to pass. Once price closes beyond the neckline, then traders are looking for an entry. And sometimes they're looking for price to close beyond, come back, retest that line just to make sure it's not a liquidity grab, and then move beyond that level of support. Ascending and descending triangles are a continuation pattern, although you do need to know that some traders classify these as a bilateral pattern instead, so there can be some disagreement about which group certain patterns go in. The triangles most often have more than 2 peak highs or lows if you're bearish, which allow a horizontal support line to be drawn. And this indicates a historic level of resistance. So it's going to kind of give you this level of resistance regardless of which support or resistance, regardless of which direction you're going, with price bouncing off of that level multiple times, usually gathering liquidity, which a lot of times you'll see price take out everybody's stop loss that has been put above this area of support or resistance. They're going to take out everybody's stop loss before bouncing a few more times and then continuing in the direction of the original trend. Typically, traders will enter after this baseline breakout. So they'll wait as price breaks out of that. Sometimes they'll wait for price to come back and retest that zone again and move on out. And sometimes just, as soon as price will close above this line, they go ahead and enter, or they may look for a certain type of candle or a lot of momentum. There can be a lot of different confluence with that. But traders will take a long position on the ascending triangle, and they're going to take a short position on the descending triangle. And you know what? There are tons more types of patterns. There's cup and handles, wedges, pennants, flags, rounding, and so many more. But the biggest thing to take away from this section is that familiarizing yourself with these can be beneficial. And I can guarantee that if you're in the trading world for long enough, you will become familiar with them, whether or not you ever trade patterns, or you know, even if you don't really have anything to do with that, just from exposure. I know several true traders, not just Forex marketers or Forex Instagrammers, that actually make great money just trading double tops and bottoms with a fully fleshed out strategy. It can be done for sure. And that pattern is one that I actually traded on and off and really enjoyed during my first year of trading, as I was learning about different confluences and looking at different indicators and different things, you know, that the market would kind of give you as price moved around. I actually enjoyed it. And like I said, know people that actually make money with it. Let's take a peek at identifying some of those patterns we just took a look at. And let's just pull out some M's and W's. Those are a very, very popular pattern that people trade with. And just right off the bat, you can kind of see here a M pattern, double top right there, and price plummeted. And if we zoom in right here, what you're going to see is that you have, you know, a peak here, you have a peak here, and then you have your neckline right here. And so what price did is price came down, and once it traded through the neckline, you see right here, you had like a pin bar. Let me zoom in a little bit more. You had a pin bar that closed below the neckline right here, but price bounced right back up into the range. And this is where I was talking about that a lot of times people wait until price closes below, then comes back and retests that zone before then pulling and dropping or you know, price flying, you know, if you're in a bullish trend. So a lot of times people wait for that retest. A more conservative approach could have been using, you know, this low right here as the neckline. But if you just look at what makes sense, you had a lot of candles using that line right there as the support. And you have support and resistance. You had several bounces right there. And then it's even correct because right here it comes back and retests that zone. And so that right there would have absolutely been a perfect entry. I would have waited until that price closed, put my stop loss above that, and you would have had, you know, if you rode that all the way down, you would have an 8-to-1 risk to reward ratio, which would have been excellent. So, and this is on a daily chart, so the number of pips would have been higher. You know, I don't know that I don't like 60 pips, you know, for my stop loss, but just depending on your trading strategy, that might totally would have been okay. But that would have been an absolute winning trade and perfect pattern setup there of the double top. You really kind of have a small W here if you look at it, especially if we went down in time frame. You right here would have had where price came down and bounced, moved out of that area, created a new structure, bounced again, and then price flew on out of there. You again right here have same thing, double top, where you have those M's, and price came, had a peak, came down here, created the neckline, a peak, actually had two bounces right here, so that technically could have been a triple top, especially because this is on the daily time frame, and then price dropped. You had your neckline, you know, you could put your neckline here, and that's probably where I would put it, because if you look at this, here, let me just clean this up real quick. If you look at this, you had a bounce here, you had a bounce almost right there. You had a liquidity grab there, which is manipulation, and I love. And then you had two bounces right here on that zone. So that probably would have been the neckline for me that I would have used. But in this case, you would have had your neckline and price came and dropped down, and price came right back up. Now on your lower time frames, you're going to see this, and we'll just look at it. We'll just go back. And so if you were live trading this and had you been watching this, what you had, we'll go down to the hour so you can kind of see this broken down. So this is the hour. Here was the neckline right here. If you just pull this across, you actually had 2 opportunities for entry if you were watching this trade, and you could have entered on either one of them, and we could have taken a short sell right here and put our stop loss right above the neckline, and of course price kept going there for a while. And just depending on how you managed your trade, you could have grabbed at least 262 pips and a 10-to-1 risk to reward ratio, which is really good. I just scrolled back a little bit here just to show you this head and shoulders. You have shoulder 1 right here. Price came back down, peak, high peak here, came down, created the right shoulder, and then price pushed on down from there. So you have shoulder 1 here, left shoulder, you have the head here, and then you have the right shoulder here. And this would have been your neck. Oop, I didn't grab it. This would have been your neckline. And right here on this head and shoulders, I would have looked to take a short position here. You would put your stop loss right above structure, and this, depending on your trade management, you could have had about a 1 to 3.5 risk reward ratio, which is really good. I don't know that I would have been comfortable with my stop loss that far, so it's possible that I could have gotten stopped out on this wick just depending on my entry. However, if your stop loss is above this 50 pips, just depending on, you know, what your strategy says, would be a lot more acceptable when you're looking for, right here is a 421 pip run, just depending on how you manage your profits and your trades. Here is another head and shoulders. You have price pushed up, formed the left shoulder, came down, formed the head, came down to similar support level, formed the right shoulder, and then price pushed down. And what you had again was left shoulder, head, and right shoulder here. And let me just clean that up a little bit. We're going to use this as the neckline, and when price closed below, it comes back, it absolutely retests this neckline, at which time that would have been a valid entry. We would have put stop loss right above your last structure, which is here. And depending on how you managed your trade and where you put your stop loss, that's kind of a big stop loss for me. My stop loss probably would have been closer to 50, 60 pips in that. And then you still bagged 296 pips, just depending on where you're exiting your trades and where your profit targets would be. And you got a 1 to 5, almost 5.5 risk to reward. And so that would have been absolutely a great trade. And here's another head and shoulders right here. You have price coming down, forming left shoulder, coming back to resistance, forming the head here, coming back to resistance, forming the right shoulder here, breaking the neckline, and then price just flies. And you have here your area of neckline here. And price did not come back and retest it after it broke the neckline. However, just depending on lower time frames, you probably got some bounces during this daily candle, because remember when I said just because the candle looks like it was one move, on the lower time frames you had price going all over the place. So you probably had some bounces here at this level, and so on the lower time frame you would have dialed in your entry. And just depending on where you put your stop loss, now this would have been a little bit of a big stop loss for me, so I would have probably put my stop loss at the opening of that candle. And just depending on how you managed your trade with this and what your trading plan and rules are, you would have had a 1 to almost 12.5, almost 13 risk to reward, 746 pips. So you risked 60 pips for 746. So that was just a kind of a quick glance at some of the patterns. I am not a pattern trader. I have traded patterns live in the market, but I just found better strategies that fit my personality better and that fit my trading style better and that I found a lot more profitable. But knowing these a lot of times can give you more information. Like I said, if you're in a live trade and you see a pattern setting up that's a reversal pattern and that's not in your direction, you might want to know that. If you're looking for additional confluence and you're saying, oh, I look for price to reverse around, this price point based on historical data or based on an order block or based on imbalance, whatever, you can look at that and say, oh, and this pattern, this reversal pattern setting up, so that's an additional confluence. So sometimes just keeping it in your mind, even though it's not a part of your trading strategy. But as I said, you don't need to necessarily memorize it because you're going to be exposed to this over and over. And so you'll come to where you just kind of recognize them on the charts too.